Hello students and welcome to the lecture. So students, as we know that we are covering the banking awareness practice questions and this is going to be a part 9. In previous lecture we had covered the part 10. Now in this lecture we are going to start with the part 9. In this again we will practice some questions and then we will take the summary of them. Okay? But before proceed further we have a small disclaimer presented over here. And the disclaimer is like the images used in a slide deck are for educational purposes only. We respect the intellectual property rights of the original creators and owners of these images. If you are the owner of any of the images used in this deck and have any concerns or issues, please contact us at sathee@iitk.ac.in and we shall remove the images. So let's first begin with the question number 1. Which of the following is an investment advisory discipline? Corporate industrial finance, offshore banking, wholesale banking, wealth management, trade finance. To answer this, you will have 10 seconds, then I will give you the answer. So your time starts now. Okay, the time's up. Correct answer is D, wealth management. Go by the explanation. Wealth management is an investment advisory discipline that focuses on providing financial services and investment strategies to high net worth individuals and families. Involves a comprehensive approach to managing a client's financial life, including investment management, financial planning, tax strategy, and estate planning. Therefore, wealth management is the only option that specifically hits the description of an investment advisory discipline. Question number 2. The part of a company's earnings or profit which are paid out to the shareholders is known as capital gains, taxes, interest on borrowings, dividends, panel interest. Again, you will have 10 seconds to answer. Time starts now. Time's up. Correct answer is dividends. Go by the explanation. Dividends are the portion of a company's earnings that are distributed to its shareholders as a return on their investment. When a company makes a profit, it could choose to reinvest those profits back into the business or pay a portion of them to shareholders in the form of dividends. Thus, dividends are the correct answers as they specifically denote the profits paid out to the shareholders. Question number 3. NABARD is responsible for regulating and supervising the functions of investment and industrial finance banks, cooperative banks and regional banks, corporate finance and overseas banking units, private sector and multinational banks, Reserve Bank of India. To answer this, you will have 10 seconds, then I will give you the answer. So your time starts now. Okay, the time's up. Correct answer is cooperative banks and regional rural banks. Go by the explanation. NABARD, National Bank for Agriculture and Rural Development, primarily responsible for the development and support of rural infrastructure and agriculture in India, plays a key role in regulating and supervising. First is cooperative banks. These are banks that are owned and operated by their members. NABARD oversees their functioning to ensure they are working efficiently and serve their purpose. Regional rural banks got established to provide credit and develop the rural economy. NABARD supervises them to promote rural development. Therefore, the primary responsibility of NABARD lies with cooperative banks and regional rural banks. Question number 4. The Government of India announced a funding for lending scheme for the beneficiaries of this scheme. Commercial banks, regional rural banks, microfinance institutions, finance departments of state governments, none of these. Answer this 10 seconds you have. Time starts now. Time's up. Correct answer is commercial banks. Go by the explanation. The funding for lending scheme introduced by the Government of India designed to enhance the availability of credit to specific sectors, particularly priority sectors like agriculture, housing and small businesses. Under the scheme, the government provides funds to the commercial banks at a lower interest rate, enabling these banks to lend more readily and a reduced rate to end borrowers. Key points: commercial banks as beneficiary. The primary beneficiaries of the scheme are commercial banks. They receive funds from the government, allows them to lend more than at lower rates, particularly to sectors that are deemed priority. Objective: aims to encourage banks to increase lending to businesses and individuals who may otherwise face higher borrowing costs or might not qualify for loans. Impact on economy: by providing commercial banks with more funds, the scheme aims to boost credit availability in the economy, thereby stimulating growth and supporting various sectors. So, the correct answer is commercial banks. Question number 5. The arrangement under which bank sells insurance product acting as the agent of the respective companies called the insurance joint venture, bank assurance model, hybrid insurance model, insurance bank broking, integrated model. To answer this, 10 seconds you have, then I will give you the answer. So time starts now. The time's up. Correct answer is bank assurance model. Go by the explanation. The term bank assurance refers to a partnership of collaboration between a bank and an insurance company. Bank sells insurance products to its customer. In this arrangement, bank acts as an agent for the insurance companies, providing a convenient channel for customer to purchase insurance alongside banking services. Key points about bank assurance: dual benefit. Customer benefit from the convenience of accessing both banking and insurance services in one place, while banks could earn additional revenue through commissions and fees from selling insurance products. Regulatory framework. Arrangement regulated by the financial authorities and bank must comply with the specific guidelines to ensure that they provide suitable insurance products to their customers. Type of products. Product offers could including life insurance, health insurance, general insurance, among others. Question number 6. The process by which a life insurance policyholder could transfer all rights, title, and interest under a policy contract to a third person is known. Assignment of the policy, hypothecation of the policy, reinvestment of the policy, negotiation of the policy, nomination of the policy. To answer this, you have 10 seconds. Time starts now. Time's up. Correct answer is A, assignment of the policy. Go by the explanation. Assignment of the policy refers to the process by which a life insurance policy holder transfer all rights, title, interest under the policy to a third person. Means that the assignee, the person receiving the rights, could exercise the rights that were held by the policy holder, including the right to receive benefits or payout from the policy. Hypothecation of the policy typically refers to using an asset as collateral for a loan while retaining ownership. Does not involve transferring rights to another person. Reinvestment of the policy generally refers to the process of using the benefits or proceeds from a policy to purchase another investment, not transferring rights. Negotiation of the policy, not commonly used in the context of insurance, does not refer to the transferring rights. Nomination of the policy refers to the process where the policyholder designates a beneficiary who will receive the benefits upon the policyholder death, does not transfer rights of the policy itself. Thus, the correct answer is assignment of the policy. Question number 7. The concept of microcredit essentially concentrate on consumption smoothing as and when needed, providing safe place to hold savings, accepting deposits, provision of credit to the poor, facility to transfer money. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is D, provision of credit to the poor. Go by the explanation. Microcredit refers to the provision of small loans to individuals, particularly in low-income communities, enable them to start or expand small businesses. Main aim of microcredit is to provide financial services to the poor who typically lack access to the traditional banking facilities. This concept is crucial for empowering individuals to become self-sufficient and improve their economic conditions. Question number 8. An equity share also commonly refers to as ordinary share, debenture, convertible share, security receipt, preferred stock. To answer this, you will have 10 seconds and I will give you the answer. Your time starts now. Time's up. The correct answer is ordinary shares. Go by the explanation. Equity share, commonly refers to as an ordinary share, represents ownership in a company and entitles the shareholder to vote at general meetings and receive dividends. Equity shares are the most common type of shares used by the companies. Though correct answer is ordinary share as it is synonymous with equity shares. Question number 9. The abbreviation EMV stands for European Marginal VAT, Expected Monetary Value, Essential Monthly Voucher, Europay, MasterCard and Visa, none of these. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is B. Europay, MasterCard and Visa. Go by the explanation. EMV stands for Europay, MasterCard and Visa, which is a global standard for secure payment transaction using chip cards. EMV technology enhances the security of card transactions by using a chip embedded in a card that generates unique transaction codes, making it difficult for fraudsters to replicate. Question number 10. Which of the following is not correct regarding the systematically important non-deposit taking NBFCs? NBFC and the SIS. They came into being in the wake of the recent global recession. NBFCs with asset of 100 crores above are being classified as NBFC and the SIS. Prudential regulations applicable to them. It was created 2006, none of these. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is A. They came into being the wake of the recent global recession. Go by the explanation. Context of establishment. Systematically important NBFCs were not specifically established as a direct response to the global financial crisis of 2007 to 8. The concept and regulatory framework around NBFCs had been evolving for some time. Crisis highlighted the need for better regulation of financial institutions, including the NBFCs. These entities existed prior to the crisis. Regulatory development. RBI and the government took steps to classify and regulate NBFCs more stringently following the crisis. However, the classification of NBFC and the SIS not a direct outcome of the recession itself, but a rather continuation of efforts to strengthen financial oversight. Other options. NBFC asset of 100 crores above indeed classified as NBFC and the SIS. Prudential norms are applicable, which is also correct. While the specific regulatory framework evolved over time, this statement could be misleading, but it's often interpreted in the context of when former guidelines were issued. None of these implies that all previous statements are correct, which is not the case given the option A is misleading. Question 11. Which of the following is an example of indirect tax? Wealth tax, corporation tax, value tax, estate tax, income tax. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is value added tax. Go by the explanation. Indirect tax is a type of tax not directly levied on the income or profit of an individual or organization. Instead, it is imposed on the goods and services. Consumers pay these taxes when they purchase goods or services. Tax collected by an intermediary, like a retailer, from the consumer and then paid to the government. VAT is a classic example of an indirect tax, charged at its stage of production based on the value added at that stage, making it ultimately borne by end consumer. Question number 12. What is the maximum loan limit under the revised credit linked capital subsidy scheme for technical application by the government of India? 10 lakhs, 40 lakhs, 78 lakhs, 100 lakhs, 150 lakhs. You have 10 seconds to answer. Time starts now. Time's up. Correct answer is 100 lakhs. Explanation. Under the revised credit linked capital subsidy scheme, CLCSS, Government of India provides financial assistance to small and medium enterprise for the purpose of upgrading their technology. The scheme aims to enhance the competitiveness of these enterprises by facilitating access to the modern technology. Maximum loan limit under the scheme is 1 crore or 100 lakh. Means that eligible SMEs could avail loans up to this amount to support their technological advancement. Subsidy under the scheme is a percentage of the loan amount, making it more attractive for businesses looking to invest in upgrading their system. Therefore, maximum loan limit under the revised CLCSS for the technical abbreviation is 100 lakhs. Question number 30. Which of the following is correct regarding the functions of the Indian Mortgage Guarantee Corporation? It mitigates risks taken by lenders, provide mortgage guarantees to banks, provide mortgage guarantees to housing finance companies, makes easier for people to get access to home loans with lower down payment amounts, all of the above. To answer this, you will have 10 seconds. Time starts now. Time's up. All of the above. Go by the explanation. Indian Mortgage Guarantee Corporation several key functions aimed at facilitating the housing finance sector. Like first, mitigates risk taken by lenders. Helps reducing the risk for lenders by providing guarantees on mortgage loans, makes lenders more willing to extend credit. Provides mortgage guarantees to banks. Provides mortgage guarantees specifically to banks, helping them managing the risk associated with home loans. Provides mortgage guarantees to housing finance companies. Also offers mortgage guarantees to housing finance companies, further promoting the housing finance market. Makes easier for people to get access to home loans with lower down amounts. By providing guarantees, IMGC enables lenders to offer loans with lower down payments requirements, making ownership more accessible. All these statements accurately describe the functions of the Indian Mortgage Guarantee Corporation. The correct answer is E, all of the above. Question number 14. In which form is the cash reserve ratio to be maintained with the Reserve Bank of India? Minimum cash reserve, gold, approved securities, both A and B, all of the above. To answer this, you will have 10 seconds. Time starts now. The time's up. Correct answer is A, minimum cash reserve. Go with the explanation. CRR is the percentage of bank's total demand and time liabilities must be maintained in the form of cash reserves with the Reserve Bank of India. Requirement ensures that the bank have enough liquid cash available to meet the withdrawal demands of the customers. Minimum cash reserves. Bank must maintain CRR in cash form with the RBI, which means they need to hold a certain percentage of their NDTL as cash with the central bank. Gold, approved securities. Banks may hold gold and securities as part of their overall asset portfolio, not forms in the which CRR is maintained with the RBI. Question number 15. Which of the following correctly explains reverse merger? It is the acquisition of a privately company by a public company, also known as special takeover. The privately traded corporation is called as a shell. Involves the recognition of capitalization of the acquiring capital, all of the above. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is D, involves the reorganization of capitalization of acquiring company. Go by the explanation. Reverse merger is a transaction in which private company acquires a public company to bypass the lengthy and often costly process of ongoing public through an IPO. While options A, B, C may have elements of truth, they don't fully capture the essence of what a reverse merger entails. First is reorganization capitalization. In a reverse merger, the capital structure of the public company or shell companies recognized they could involve changes in equity, debt, and overall financial structure of the company. Private company typically becomes the controlling entity and previous shareholders of the public company may end up with a different stake in the new entity. Acquisition aspect. While A mentions that it involves the acquisition of privately company by a public company, it is actually the other way around. A privately company acquires a public company. This misrepresentation could lead to confusion. A special takeover and shell company. While B and C contains levered terms, they do not accurately define the concept of a reverse merger in a way that conveys the structural changes and the intent behind such transaction. Question number 16. What is the minimum period for which a fixed deposit could be opened in India? 3 days, 7 days, 15 days, 30 days, 60 days. Time starts now. Time's up 7 days. In India, the minimum period for which a fixed deposit could be opened is typically 7 days. Means that the bank allows customer to create fixed deposits for a duration as short 1 week. So flexibility for depositor. Offering a minimum tenure of 7 days provides flexibility for individuals or businesses who may not want to commit their funds for longer periods. Standard practice. Most banks adhere to this 7 days minimum period. Though they often provide various options for longer tenures such as 15 days, 30 days and beyond. Interest rate. FD is for short term, like 7 days. The interest is offered, such as depository may be lowered compared to those for long term deposits. Question number 70. Chief regulator of a commodity exchanges in India is Securities and Exchange Board of India, Reserve Bank of India, Competition Commission of India, Forward Markets Commission, Ministry of Consumer Affairs, Food and Public Distribution. 10 seconds you have to answer. Time starts now. Time's up. Correct answer is D. Explanation. The FMC was the chief regulator of the commodity exchanges in India until it was merged with the SEBI in 2015. After this merger, SEBI took over the regulation of commodity market as well as security market. FMC, prior to the merger, FMC was responsible for regulating and promoting the commodity futures in India, oversaw the function of commodity exchanges, and ensured that the market operated smoothly. Then Securities Exchange Board of India. After the merger, SEBI became the overarching regulatory authority for both securities and commodities. However, in this context of the specific question regarding the chief regulator prior to the merger, FMC is the correct answer. Which of the following does not constitute an asset on the balance sheet of a company? Cash, amounts receivable, tools, equipment, capital stock, all of these. 10 seconds, time starts now. Time's up. Correct answer is capital stock. Go by the explanation. In the context of a company's balance sheet, assets are resources owned by a company that have economic value. Cash, asset represents the liquid funds available to the company. Amounts receivable represents money owned to the company by customer or the securities and classified as an asset. Tools and equipment, tangible assets used in operations, so they are also included as asset on the balance sheet. Capital stock refers to the equity capital raised by the company through the issuance of shares. While represent ownership of the company, it's not considered as an asset. Instead, it is a part of shareholders' equity on the balance sheet. All of these. Since capital stock does not constitute an asset, this option is incorrect. Question 19. Which of the following correctly explains the situations of credit risk? Business or consumer does not pay a trade invoice when due. Business does not pay an employee's earned fund wages when due. An insolvent insurance company does not pay a policy obligation. Consumer fails to make a payment due on mortgage. All of these. 10 seconds you have to answer. Time starts now. Time's up. All of these. Go by the explanation. Credit risks refer to the risk of loss arising from a borrower's inability to repay a loan or meet contractual obligation. Each of the options listed describes a situation where credit risk may arise. First, business or consumer does not pay a trade invoice when due. This is a classic example of credit risk where the creditor may not receive payment for goods or service rendered. Business does not pay an employee's earned wages when due. While primarily a labor issue is, it can indicate financial stability in the business, which could lead to the credit risk for any creditors relying on that business stability. An insolvent insurance company does not pay a policy obligation. Represent credit risk where the insurer fails to meet obligation due to the insolvency. Consumer fails to make a payment due on a mortgage. Direct example of credit risk, as the lender may incur losses if the borrower defaults on the mortgage payment. Question number 20. According to a recent Reserve Bank's instruction on banking matters, banks could not accept interest fee depositors other than in demand deposit account, term deposit account, current account, both A and B, none of these. 10 seconds you have to answer. Time starts now. Time's up. Correct answer is C, current account. Explanation. According to the RBI instructions, banks are generally prohibited from accepting interest-free deposit except in certain circumstances. First is demand deposit account. Typically refers to the account from which funds could be withdrawn at any time without notice, while these accounts could be interest bearing or non-interest bearing, usually associated with current accounts which do not typically pay interest. Term deposit account. Accounts usually earn interest and not classified as interest-free depositors. Current account. Generally interest-free and are used primarily for frequent transactions by businesses and individuals. Bank could accept deposit in current accounts without paying interest. Both ABD. Since term deposit accounts do earn interest, this option is incorrect. None of these. This option is also incorrect as current accounts are accepted. Correct answer is current account, as banks could accept interest-free deposits primarily in current accounts. Question number 21. Which of the following is correct regarding the statute liquidity ratio? Restrict commercial banks leverage in pumping more money into economy. maintain only in form of cash, controls liquidity in banking system, does not ensure the solvency of commercial bank, none of these. To answer this, you have 10 seconds. Time starts now. Time's up. Correct answer is A. Restrict commercial banks leverage in pumping more money into economy. Explanation. SLR is a regulation set by the RBI that maintains banks to maintain a certain percentage of their NDTL in the form of liquid assets such as gold, cash, or government approved securities. Okay. So first is restricting leverage by requiring banks to hold a specific portion of their demand of their deposit liquid assets. SLR effectively limits the amount of money that banks could lend out. This means that the higher the SLR, the less money is available for banks to use for loans investment, thereby restricting their leverage. Impact on money supply. A higher SLR could tighten liquidity in the banking system, which could subsequently lead to a reduction in the money supply in the economy. This restriction could affect the economic growth as less money is available for businesses and consumers to borrow. Comparison to the cash reserve ratio of CRR. While CRR mandates banks to keep a portion of deposit in the form of cash reserves with the RBI, SLR requires them to hold liquid assets, making SLR another tool for controlling the credit growth in the economy. Question number 22. Which of the following types of mutual funds not marked with brown color? Diversified funds, income funds, sectoral fund, index funds, large cap funds. To answer this, you will have 10 seconds and I will give you the answer. Time starts now. Time's up. Correct answer is income funds. Go by the explanation. In the context of mutual funds classification, color coding used to help investors identify different types of funds and their associated risk level. So first is the brown color, generally associated with funds that focus on specific investment strategies. Sectoral funds. If funds invest in specific sectors of the economy like technology, healthcare, etc., usually marked brown. Index fund. Funds track a specific market index and also often categorized under brown. Large cap funds. These invest primarily in large cap companies and may also be marked with brown. Income funds. These funds primarily focus on generating regular income through investment in debt instruments like bonds and debentures, typically associated with a different color, often blue or another designation, that differentiates them from growth-oriented or equity-focused funds. Question number 23. Which of the following comes under the national income? Wages from employment and self-employment, profits to firms, interest to lenders of capital, rents to owners of land, all of the above. To answer this, you will have 10 seconds. Time starts now. The time's up. Correct answer is E, all of the above. By explanation. National income refers to the total value of all goods and services produced in a country over a specific period, usually measures annually, encompasses the various forms of income earned by residents of a country, which includes wages from employment and self-employment, includes all compensation paid to employees, including salaries and wages from self-employment, contributing significantly to national income. Profits to firms. The profits generated by a business after deducting expenses are part of national income, reflects the income earned by firms from their operations. Interest to lenders of capital. The interest income earned by individuals or entities that provide capital like bank investors, including the calculation of national income. Rents to owners of land. The rent received by landowners for the use of their land is also considered as a part of national income. Question number 24. Which of the following values considered by a bank when it gives loan against LIC policy? Face value, surrender value, insured value, both A and B, all of these. To answer this, you will have 10 seconds. Time starts now. Time's up. B, surrender value. Explanation. When the banks consider a loan against a life insurance corporation policy, typically assesses the following values. First is face value, amount payable upon the death of insured. However, it is not typically used as the basis for loan calculations. This represents a future payout rather than the cash value of the policy. Surrender value, amount the policyholder would receive if they decide to terminate the policy before its maturity. This value reflects the cash accumulation within the policy, usually the Main consideration for banks when granting loans against an LIC policy. Insured value. This term is generally less commonly used in the context of loans against a policy. Refer to the coverage amount, but it is not a primary consideration for loan valuation. Question number 25. Which of the following is a traditional type of open market operations used by the Reserve Bank of India? Outright purchase, cash the ratio, discharge liquidity ratio, repurchase agreement, both A and D. To answer this, 10 seconds you have. Time starts now. Time's up. Both A and D. Goal explanation. OMO refer to the buying and selling of government securities in the open market by Reserve Bank of India to control the money supply and influence interest rate. First is outright purchase. This is a traditional type of open market operation where the RBI buys government securities from the market, injects liquidity into the banking system. Cash reserve ratio is a monetary policy tool not classified as an open market operation. Instead, refers to the percentage of a bank's total deposit must be held in reserve with the RBI. SLR. Similar to CRR, SLR is a regulatory requirement of banks, does not fall under the open market operations. Repurchase agreement, also a traditional type of open market operation. In a repo, the RBI lends money to banks against securities as collateral, thus influencing liquidity. We have finished this topic. Now the part of summary. We have talked about investment advisory discipline, company earnings distribution to shareholders, NABARD regulation, funding for lending scheme beneficiaries, banks selling insurance products. Transferring rights under a life insurance policy, concept of microcredit, equity share, common name, EMV abbreviation, systematically important non-deposit taking NBFCs. Example of indirect tax, maximum loan limit under CLCSS, functions of Indian Mortgage Guarantee Corporation, cash ratios maintenance, reverse merger explanation. Minimum fixed deposit period in India, chief regulator of community exchanges, non-asset of company balance sheet, credit risk situations, interest-free deposit accepted by banks. Statutory liquidity ratio, mutual funds, color coding, components of national income, loan against LIC policy, values considered traditional open market operations by RBI. With this note, we have finished this topic. It is requested to all of you kindly revise the facts and figures that all we have discussed in this lecture. Keep yourself ready for the next lecture. With this note, let's end this lecture and thank you.